Interested in learning about the price to sales ratio? It's a common valuation metric that helps you understand how much you're paying for the stock relative to the amount of revenue that company generates. Hey, welcome to Rynance, the channel centered around your financial education to help make you a better investor. Be sure to subscribe to the channel as I upload new educational stock market videos every week. The price to sales ratio is a valuation metric that compares the stock's current price to their sales numbers. The calculation for this ratio can be found by dividing the stock's market cap by their yearly revenue. It tells you how much you are paying in stock price for each dollar of revenue the company generates. Investors use price to sales to judge if the company is over or undervalued relative to that company's peers. This ratio can be especially useful when attempting to value a stock that is not currently profitable or only slightly profitable, as you only need to look at their current revenue amounts. Some investors even prefer price to sales over other valuation ratios like the PE ratio. The price to earnings ratio relies on the company to be profitable, which may not always be the case and is commonly criticized in that the profit figure can be easily manipulated through accounting techniques. Thus, price to sales can offer a different valuation perspective as revenues are typically more stable year to year, they cannot be easily manipulated, and every company will have a revenue figure. If you'd like to learn more about PE ratio, you can click the link here to my full-length video that covers it in detail. For price to sales, there are two different ways you can calculate it, either on a market cap basis or on a per share basis. The first method, market cap basis, is to divide the stock's market cap by its yearly revenue, also known as sales. For the revenue or sales figure, you can find it in the income statement of the company's most recent earnings report. It should be noted that you want to make sure this is a yearly figure and not just a quarterly figure. The other method is to calculate the ratio on a per share basis. For this, you need to divide the stock's price per share by their yearly revenue per share. You would need to find the revenue in the income statement as well, and then divide that by the number of shares outstanding to arrive at revenue per share. Both ways will arrive at the same conclusion, but I would recommend to use the first approach as it requires less work, so there's less room for error. For the price to sales ratio, you'll get a multiple, in which lower is better and higher is worse. So if we have company A with a price to sales multiple of 5 times and company B with a price to sales multiple of 2 times, this ratio implies that the shares of company B are of better value. Simply put, for each dollar you'd have to spend in share price, company B offers you more value in the amount of revenue that they make. As with most valuation ratios, there are 2 different time frames you can look at, trailing and forward. The trailing price to sales ratio would rely on financial information that has already been reported and is using data from the last 1 year of operations. This is usually written like this, in which the TTM part means trailing 12 months. A forward price to sales ratio is referencing analysts' expectations for the coming year. Keep in mind that this is just an estimate, as nobody can predict the future, but it can be used as a guide for what to expect. So let's look at a quick example of why this may be relevant. We have a hypothetical company here, Riley's Robotics, that has a market cap of $10 billion and trailing 12-month sales of $2.5 billion. If we calculate the price to sales ratio on a TTM basis, we would see that Riley's Robotics has a price to sales ratio of 5 times. This sounds rather expensive and may suggest the company is overvalued. Now let's say that Riley's Robotics is projected to have a blowout year and is expected to double their sales to $5 billion over the next year. Now that we know this, we can calculate the forward ratio and find their price to sales to be 2 times now. When we look at it this way, Riley's Robotics doesn't look nearly as overvalued, and this may be a good time to buy into the stock. It would appear, however, that the market has already accounted for this and the stock price has moved up to reflect the expected revenue growth. For this reason, it's important to look at both the trailing and forward price to sales ratios to get a better understanding of how the market is currently pricing the stock. Before I close out the video here, I would like to mention some of the limitations when using price to sales ratio. First off, the ratio does not account for profit margins within the business. Imagine a business is growing its revenues aggressively and currently has a favorable price to sales ratio. You may think this is good, but if the profit margin for the business is very low, not much of that revenue is being translated into profits. This is something to keep in mind as businesses run on profits, not just sales alone. Additionally, the price to sales ratio does not take capital structure or debt into account whatsoever. With debt, investors typically prefer businesses with low debt loads. If we have two companies with identical market caps and revenue numbers, their price to sales ratios will be the same. Let's say one of these companies is highly indebted and the other is not. The company with less debt will be more resilient and possibly a better investment, but price to sales ratio does not capture this at all. Remember to take a holistic approach when attempting to value companies and when using financial ratios. Each ratio will tell you something different, and price to sales should be used in conjunction with other ratios and metrics like PE and dividends to get a solid understanding of the company's financial standing. Thanks for watching today. How do you use price to sales ratio in your stock valuations? Let me know your process in the comments below. You can check out the playlist on screen now to learn about more financial ratios. If you learned something new, give the video a thumbs up. And as always, subscribe for more, and I'll see you in the next one.